can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation.
Transitory is back. That was Fed Chair Jay Powell addressing the uncertainty that's looming over the FOMC amid changing policy coming from the White House. President Trump reacting to Powell's presser on Truth Social, saying, quote, the Fed would be much better off cutting rates as U.S. tariffs start to transition and ease their way into the economy. For more on what's next here, we have Terry Haines. He is the founder of Pangea Policy. Terry, great to have you on here. Just want to get a sense of what you're telling clients about whether or not tariffs and the inflationary impact of those tariffs are transitory.
Well, I think you got three things here. You have what Powell said, which I won't repeat since you've just run it. Secondly, I think you've got what the Trump advisors say, which is the Trump, Bessent, and Lutnick, I think, are all saying that any impact from tariffs are far outweighed by the rest of the economic policy agenda that comes later this year. Tax cuts, pumping up manufacturing, deregulation, energy dominance, as they call it, and defense spending and so on. So you've got that. And finally, I think the markets believe that as well. But what the markets are frustrated about is frankly the timing, that you've got kind of a tariffs negative to unknown on the early side, with the vast majority of the good stuff coming later.
So talk to me about that good stuff coming later. What are you telling clients about how likely that is? Because obviously the good stuff we're referring to is the tax cuts, but there's concern that it's just going to be an extension of the same. And if we don't get more depth in tax cuts, that the market is not going to be happy.
Well, my call right now is that it's 80% likely that the market sees tax cuts in the fourth quarter of calendar 2025. Not only that, but the tax cuts are going to be very, very big because what Congress is moving towards now, and I've been talking to markets about this for a while, and it's only recently that outlets like the Wall Street Journal have started to pick this up as well, is that they're going to move to a what they call a current policy tax cut baseline that essentially allows them to cost this thing at zero, which means that the tax cuts are maximized and the pay-fors are minimized. So they're going to push for that. And another reason why I say it's going to be 80% likely is because you can look at the government shutdown business of last week as kind of a dress rehearsal. And what you saw is Trump and Republicans staying together. And I think markets took from that a positive sign that these folks are serious about moving the rest of the economic agenda forward.
Terry, it's John Hilsenrath here. I want to drill down a little bit on the fiscal outlook. I think a lot of people hear some of these phrases and the debates in Washington about pay-fors and baselines, and their heads spin. What I see when I look at what the House passed in its framework for a budget earlier this month was $2 trillion budget deficits every year for the next 10 years, which amounts to about 6% of GDP. Which, in my mind, is a fiscal policy that's totally irresponsible at a time when we've got unemployment so low and an inflation rate so high. So my question to you is, well, how do you see the market, and what are you telling your clients about how this fiscal policy is going to affect the supply of Treasury bonds and yields on 10-year Treasury notes? Because I don't see how this comes together. I don't see how the market gets the tax cuts it wants unless they're serious in Capitol Hill about doing spending cuts. And I don't see it in the House framework right now. The House framework has $2 trillion budget deficits penciled in as far as the eye can see.
Right, and good to see you, John. A couple of things. One is, I'm with you that this isn't a serious attempt to cut debt and deficit. That was never going to happen. You had two political parties even last year. The one political party, the Democrats, wanted to continue spending without end. The other political party, the Republicans, in the Congress, their view was, look, we should cut 1% out of 30% of the budget, which is discretionary spending, and not touch the 70% that's mandatory spending. So there's not political will here, and I think there's not going to be political will here when you're talking about a world in which everybody understands that some efficiencies have to come out of Medicaid, for example, and the president doesn't have Congress's back on making those efficient savings to Medicaid. The president's view is Medicaid shouldn't be touched. Then you're in a situation where debt and deficit are really not going to be lessened at all. My view of this is that, and this is why the baselines, as I know, they make a lot of people's heads spin, but you know them very well, and so do I. This is why the baseline issue, even though it's kind of a nerdy thing to point to, is important, because if they take current policy, then the pressure to cut on pay-fors is much less, and gives them a lot more headroom to increase the tax cuts. Their bet, Trump's bet, Congress's bet, is a very large political bet that that tax cuts, if they're large, turbocharge the economy a great deal, really help politically, of course, but beyond that, pump up this whole American economic exceptionalism story, and make the United States much more of a preferred destination for investment of all kinds as compared to the rest of the world, whether it be China, the European Union, or elsewhere.
So Terry, when you're talking to your sources in Washington and they're asking you how the markets are digesting all of this, I'm sure these are two-way conversations. What are you telling them about the bond market? Do you think the bond market will sign off on $2 trillion or more deficits as far as the eye can see? Do you think there's the capacity in the bond market to keep swallowing all these treasuries that are the likely result of the fiscal policies that are being formulated in Washington?
I think what matters more to them than anything else is the growth prospect, the economic growth prospect, number one. And number two, what matters is what the rest of the world looks like. And if the rest of the world continues in the relative doldrums and the United States continues to look like the preferred bet, I think they probably do end up swallowing it. Yeah, I mean, I sense them as very much in a wait and see kind of mode right now.
And Terry, switching gears a bit, the Fed's independence came up again after Trump's firing of those two Democratic commissioners at the FTC. I want you to listen to what Jay Powell had to say about this and get your thoughts on the other side.
Sure.
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
And that's Powell referring to that incredible line, not permittable under the law, when talking about Federal Reserve members being fired. Terry, is there a risk to Fed independence under this administration?
Well, first, Powell's right about the unfireable nature. Let me just say that at the top. Secondly, I can well understand why markets continue to be nervous about this. They were nervous during the first 4 years of the first Trump administration. They're nervous again now. The FTC firings, I think, increased that nervousness, and I wrote that on Tuesday night right after it happened. That said, I don't think it's very likely. In fact, I think it's almost impossible to have a scenario where Powell's actually removed or some other governor is removed, and I'll tell you why. Firstly, I think you've got a markets rebellion that would happen. Secondly, I think you've got a variety of advisors, not least of whom are Bessent and Lutnick, that would urge very strongly against doing anything like that. And finally, I think Fed independence, in the sense that the Board of Governors, the FOMC and the Board of Governors feel free to act as they wish, I think has been proven, frankly. It's forgotten and not well understood by markets that right after Powell got confirmed in 2022 by a Democratic Senate, it was assumed by Biden and that Democratic majority Senate that the Powell Fed would continue to be dovish. The moment they were confirmed, they immediately went hawkish. and confounded expectations, and it largely got inflation under control. I have no reason to believe that Powell or the governors would do anything different now.
Terry, one of my favorite pieces of political intrigue from the meeting yesterday was Governor Chris Waller's dissent. It's highly unusual for a Fed governor to dissent at an FOMC meeting. Waller was a Trump appointee during his first administration. What do you make of that dissent? I saw it as Waller's opening bid to get the job when Jay Powell leaves in 2026.
Agreed. There's always, you well know, John, there's always auditioning going on in Washington, and I thought that was a little bit of one.